Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. So Verizon just announced a new CEO and the market didn't like it. The stock sold off about 5% on the news and is now down roughly 8% just in the month of October alone. That has pushed Verizon's dividend yield up to about 7%. Some investors are worried that a management shakeup like this could spell trouble for Verizon's dividend. We'll take a look at what this move means for Verizon's dividend safety, why the company made this change, and what I plan to do with my shares of Verizon, which I've held for 10 years now. Let's take a closer look. Why did Verizon make this change? Well, the company's been pretty frustrated by its performance. So the outgoing CEO, Hans Vestberg, took the top job in August of 2018. Since then, Verizon shares have returned about 15%, including dividends, which is pretty poor. It's far behind even AT&T's 70% return, despite AT&T cutting its dividend during that period. So Verizon has really been lagging, and that is reflecting sluggish growth. So this chart here shows the total number of wireless postpaid phone subscribers. These are the highest quality subscribers you can get. And Verizon's base has barely grown the last 5 or so years, while T-Mobile has soared ahead, and even AT&T has seen decent growth. A sell-side analyst, David Barden, noted that Verizon had been earning about 20% of the new subscribers when Hans Vestberg joined in 2018, but these days it's only getting around 5% of them. Verizon also has a problem with churn, which measures the percentage of customers that are leaving the company. So churn is basically a measure of customer loyalty and competitive pressure, and we can see that Verizon's churn rate jumped up in 2022 and has remained pretty elevated compared to T-Mobile and AT&T. Those two rivals have kept their pricing largely flat, while Verizon has pushed through some price hikes and has historically been positioned more as a premium option for folks that wanted a higher quality, more reliable network service. But today, service quality, I think, is pretty similar between the big three carriers, which has caused Verizon some problems, especially as many consumers these days are looking to trade down and find value wherever they can. So that's caused a problem for Verizon too. All of this kind of built together, plus the 5G investments, which were costly and didn't really deliver much new customer growth, to result in Verizon wanting to go a different direction to try and reignite growth. Dan Schulman will be the new CEO. He's been on Verizon's board since 2018, but he's very much viewed as a change agent rather than a steady-as-she-goes operator. So Schulman spent the most recent part of his career leading PayPal's split from eBay, so he brings a pretty significant consumer tech focus. He leaned on M&A and partnerships to really try and evolve PayPal from just being a simple payments processor to more of a platform. He also built Virgin Mobile from scratch to its sale to Sprint in 2009. So he's used to these kind of fast-paced, higher growth environments. And when he was quoted in an interview about 7-8 years ago, he compared his business philosophy to a martial arts philosophy that he follows, basically saying, hey, you need to be taking risks, you need to be moving forward, you need to be fighting. So it's very different from Verizon's kind of slow-moving, infrastructure-heavy DNA. It'll be interesting to see what Schulman wants to do with the company differently. But for now, this kind of uncertainty has rattled the market because they view some of his strong statements about wanting to redefine Verizon's trajectory and take market share across all businesses as kind of signaling he's ready to go to war and be a lot more aggressive for subscribers against AT&T and T-Mobile, which could trigger competitive responses and make for just a general tough time for the wireless industry as they duke it out. So what does all this mean for Verizon's dividend? I'll be using our website, Simply Safe Dividends, to take a closer look at Verizon's fundamentals. If you'd like to try out our website, I'll leave a link in the description below. Completely free to try, no credit card required or anything like that. Here's Verizon's stock page. We can see that 6.84% dividend yield. The dividend was raised by 1.8% last month in September. It has a BBB plus credit rating from S&P. And we recently reaffirmed Verizon's dividend safety score of 70, which places it in our safe bucket and signals very low risk of a dividend cut, though there is one exception we'll talk about with this management change. Now, Verizon has been a reliable dividend payer for a long time, including the company's predecessors. They've paid safe dividends for over 40 straight years. Last month's raise marked the 19th consecutive year of higher dividends as well. Growth hasn't been very strong, about 2% per year, but for a stock that's giving you a starting yield near 7%, that's actually pretty good. A lot of ultra high yield stocks will either cut their dividends or have no growth. Now, Verizon's fundamentals are starting to improve a little bit as well. The company went through this big 5G spending phase in 2021 through 2023. That's now phasing out, improving the company's free cash flow per share. The company's dividend coverage looks a lot better as a result, with Verizon's payout ratio expected to sit a little bit under 60%. That's a very reasonable level for a recession-resistant business like this. Consumers and businesses still need to use wireless services in all economic environments, which gives Verizon a nice sticky base of recurring revenue and cash. Right now, the company, though, has to use pretty much all of that leftover free cash flow after dividends to go towards debt reduction. Verizon's balance sheet represents the biggest uncertainty for the stock. You can see the company's leverage ratio as measured by management in this chart. The company's target leverage range is represented by these green dotted lines, and leverage spiked well above that range in 2021 when Verizon bought a lot of spectrum. It's slowly been coming down as management has worked to pay down debt and generate slight profit growth, but it's going to tick up a little bit to 2.5 turns this next year once Verizon's $20 billion acquisition of Frontier closes. If you believe analyst estimates for Verizon's profits the next couple of years, leverage will get back into management's target range by 2027. I assume the company continues to use all of its retained free cash flow for debt reduction. So the balance sheet is not necessarily a problem for Verizon's dividend today, but with a new management team, it introduces some uncertainty. If Dan Schulman wanted to go out and make a transformative acquisition, Verizon's balance sheet doesn't have the capacity to do that. At PayPal, Schulman made a number of acquisitions. None of them were huge, though, so I think it would be a pretty shocking move if he wanted to do something big, especially in an area a little bit outside of Verizon's core competency, maybe something in software or aligned with his consumer tech background. I think that's a pretty low risk, and that's one reason why we reaffirmed Verizon's safe dividend safety score for now. But investors will no doubt be listening to Schulman speak for the first time, likely when Verizon reports earnings at the end of October. Now, for me, I plan to continue holding my shares of Verizon. Like I said, I've held them since 2015. The stock, initially when I bought it, my thesis has been proven incorrect. I thought that rising data usage would drive stronger growth for Verizon than it has. You can see the stock price has pretty much stagnated. Verizon stock came down quite a bit once the Fed started hiking rates in 2022. This is what I call a bond proxy type stock, where it has a high yield and very low growth, but it's very stable and predictable. So when interest rates come up, Verizon's dividend yield also comes up to kind of compete for that investor's capital and sends its stock price down in the process. That also raised Verizon's debt costs. Interest rates will hopefully keep coming down from here and support Verizon a little bit, making its yield more attractive for investors and also reducing some of its debt costs as that plays out. Right now, the stock looks reasonably valued. This blue band represents the price you would expect Verizon to trade at if the stock was within 10% of its 5-year average PE ratio in this case. A lot of these mature blue chip stocks will trade at persistent valuation multiples over time, though sentiment can sometimes swing them above or beyond that range. Right now, Verizon is kind of sitting near the low end of that expected price band in blue. So I think it's an interesting income idea. It's kind of a steady eddy, not trying to beat the market with Verizon, although I think it could if AI does turn out to be a bubble and investors gravitate back towards these cash flow reliable businesses like a Verizon. But I also think Schulman is kind of an interesting guy for the job, hoping that he doesn't go too far out of Verizon's lane. I don't think he will get too wild with creating a price war or a big promotional battle with AT&T and T-Mobile. If anything, I'm kind of intrigued to see what efforts he has in mind to try and improve Verizon's value proposition with better customer service, maybe simpler plans, better bundling. All of these things represent kind of ways to potentially reignite Verizon's growth story, however modest it might be, without taking on a bunch of heavy physical CapEx. So I'm slightly optimistic, and I think as long as Schulman doesn't make some big, bold capital allocation change, which again, I think is unlikely, I would expect Verizon to remain kind of a steady Eddie performer with low volatility, high income for a retirement portfolio. Thank you for watching this video to the very end. I hope you enjoyed it and learned a few things about Verizon's management change and forward-looking outlook for its dividend. If this is the type of analysis that you enjoy and helps give you some peace of mind with managing your portfolio, I do recommend checking out Simply Safe Dividends. I'll leave that link in the description below. You can track your dividend portfolio, get access to all of our dividend safety scores. We share actionable income ideas. Everything's there to kind of take the stress out of investing and help you really stay the course. So give that link a check below. Thank you again for watching, and I hope to catch you next time.